At the start of the week, silver opened with what looked like a clean breakout. Within the first trading hour, price moved from 73.20 to 73.50, a sudden rise of about plus 0.41%. Retail traders rushed in, believing a bullish trend had finally begun. But almost immediately, a massive wall of paper sell orders appeared, representing nearly 70% of visible order book volume. Within 15 minutes, the market collapsed back to 72.80, erasing the entire move. What looked like natural volatility was in fact engineered pressure designed to shake out weak positions. On Tuesday, the market attempted to stabilize between 72.90 and 73.40. As price approached 73.45, stop-loss clusters were triggered. Algorithmic systems pushed heavy sell flow into the market, hunting liquidity. In a single aggressive candle, silver dropped by minus 0.75% and printed 72.60. Traders who had entered on Monday were forced out, locking in losses, while the same entities that created the panic quietly absorbed contracts at discounted levels. By Wednesday, silver formed a tight compression range between 72.50 and 72.90, an inside bar structure that often precedes volatility expansion. Retail traders expected a technical breakdown. Instead, nearly 80% of sell pressure came from short-lived paper orders that smashed price down to 71.90. Physical demand did not change. No real selling occurred in the underlying market. The breakdown existed only on screens, manufactured to inject fear into chart-based systems. Thursday brought a temporary sense of relief. Gold advanced by plus 0.62%, and historically gold leads silver in directional movement. Silver reacted instantly, jumping from 71.95 to 72.70. Momentum traders re-entered the market, expecting continuation toward the 73.80 region. But the rally was abruptly capped. Algorithmic resistance appeared at 72.70, forcing price to stall near 72.10. The recovery was not allowed to develop because the primary objective was not price discovery, but control. Friday delivered the classic liquidity sweep. Early in the session, silver broke below the 72.00 level, triggering cascades of forced liquidations. In less than half an hour, price lost minus 1.1% and printed 71.20. This was the moment when most remaining long positions were wiped out. The public narrative blamed weak demand and risk-off sentiment, but internal order flow revealed aggressive accumulation by large players who had just created the sell-off. During the weekend, when futures trading slowed, activity quietly shifted to the physical market. While charts showed stagnation, physical silver demand surged by roughly 65% compared to the previous weekend. Vault inventories tightened, premiums widened, and long-term buyers increased orders. This divergence between paper weakness and physical strength had become routine, and it exposed how disconnected price discovery had become from real supply and demand. By Sunday evening, positioning data suggested that the next operational zone had been prepared between 73.80 and 74.20. This range represented a decision point. Either a sharp plus 1.5% rally would be allowed to draw in fresh longs, or a coordinated breakdown of minus 2% would be launched to repeat the cycle. The market was no longer reacting to fundamentals. It was moving through a scripted battlefield, where price levels were not discovered, but deployed. After the violent weekly cycle ended, analysts began to reconstruct what had really happened beneath the surface. Trade-by-trade records later revealed that more than 75% of the large sell orders placed during the sharp drops were canceled within milliseconds. These were not real attempts to sell silver. They were bait, engineered to make the market believe that overwhelming supply had suddenly entered. When price slipped from 73.10 to 71.20 in under an hour, retail traders lost confidence, believing a genuine collapse was underway. In reality, the same institutions that had created the illusion were buying quietly on the other side, absorbing contracts at nearly $2 cheaper. Over the 8-year manipulation period, this pattern repeated hundreds of times. Every time silver tried to break above resistance zones such as 74.00 or 76.50, a wall of paper volume, often equal to 60 to 80% of total visible liquidity, would appear, forcing a reversal. Meanwhile, the physical market showed the opposite behavior. Coin dealers reported stock shortages, refineries faced delayed deliveries, and wholesale premiums rose by 10 to 15% whenever paper price collapsed. The charts were screaming weakness, but the metal itself was disappearing from shelves. By measuring the velocity of these fake orders, investigators found that some sequences lasted less than 1 second yet caused price shifts of -0.5 to -1.3%. Over time, this distorted the entire price structure of silver, compressing its range and suppressing rallies that should have pushed it well above the 80.00 zone. What the public saw as volatility was actually a programmed rhythm. Push price down 1%, trigger liquidation, accumulate quietly, then allow a partial rebound of 0.6% before resetting the trap again. The market was not reacting to fear. Fear was being manufactured. As investigators dug deeper into historical trading data, the scale of distortion became even clearer. During periods when silver should have surged due to inflation fears or currency weakness, the metal repeatedly stalled near zones like 75.20, 77.00, and 79.50. Each time price approached these levels, artificial resistance appeared, often representing 65 to 85% of total market depth. These were not defensive hedges by miners or long-term sellers. They were synthetic walls created to suffocate upward momentum. Over time, this suppressed silver's natural volatility by nearly 40% compared to similar commodity markets, while increasing sudden downside spikes by more than 55%. Traders noticed a recurring pattern: a slow grind upward of plus 0.3 to plus 0.6% over several hours, followed by a violent flush of minus 1.2 to minus 1.8% in less than 5 minutes. This engineered imbalance reprogrammed trader psychology. Participants stopped trusting breakouts, avoided long positions, and learned to expect pain whenever silver showed strength. The market became emotionally conditioned. Meanwhile, large institutions expanded long exposure in hidden layers, using off-exchange accumulation and internal cross-desk transfers to avoid detection. By the end of each suppression cycle, physical inventories were thinner, futures positioning was heavier on the institutional side, and the public had once again been pushed into the narrative that silver was unstable and unreliable. It was not silver that was unstable. It was the system controlling its reflection on the screen. By the fourth phase of the exposure, analysts began comparing silver's behavior with other commodities that were not subject to the same manipulation patterns. While copper and platinum were recording natural trend expansions of plus 3 to plus 5% during macroeconomic shocks, silver struggled to hold even a plus 1% move before collapsing. Statistical studies showed that during the 8-year manipulation window, silver experienced almost double the number of intraday crashes greater than minus 1% compared to its historical norm. Even more alarming was the timing. These collapses repeatedly occurred during thin liquidity sessions, especially when global participation was low. This was not coincidence. It was optimization. Algorithms were programmed to attack when resistance was weakest. At key moments, such as when silver attempted to break above psychological levels like 80.00 or reclaim long-term trend zones near 78.50, price would suddenly encounter walls of sell pressure equal to 70 to 90% of the visible order book. Traders watching in real time described it as hitting an invisible ceiling. The metal would rise slowly for hours, climbing from 74.10 to 75.30 in a steady grind, only to be smashed back to 73.40 in under 2 minutes. That single move erased nearly plus 1.6% of progress instantly. Over time, this constant suppression changed the global narrative around silver. Financial media stopped discussing it as a strategic asset and began framing it as a speculative instrument prone to failure. That perception, carefully reinforced through years of controlled volatility, ensured that public capital stayed away while institutional balance sheets quietly expanded their exposure behind the scenes. As the manipulation structure became more visible, experts began tracking how deeply it affected long-term silver valuation. During periods when inflation readings climbed above 6% and real interest rates turned negative, silver historically would surge by plus 20 to plus 30% within months. Yet during the 8-year rigging phase, the metal repeatedly failed to exceed gains of plus 7 to plus 9% before being forced lower again. On multiple occasions, price attempted to break from consolidation zones around 76.80 into the 80.00 region, only to be rejected with engineered sell bursts that erased plus 2.3% of progress in minutes. These moves were not reactions to news or supply changes. They were timed precisely with liquidity voids, where only 30 to 40% of normal market depth was available. By deploying massive spoof orders equal to nearly twice the available volume, controlling entities were able to dictate price direction with minimal capital at risk. Over the years, this tactic accumulated billions of dollars in advantage while convincing the public that silver was incapable of sustaining momentum. Meanwhile, internal reports from physical dealers revealed a completely different reality. Industrial demand from electronics and solar manufacturing increased by more than 50% over the same period, yet futures prices remained trapped in artificially compressed ranges. This divergence created a silent pressure system inside the market, where real-world consumption kept rising while screen prices were held down, storing instability that could not remain hidden forever. By the sixth phase of the unfolding exposure, the narrative inside financial circles had shifted from denial to disbelief. Analysts mapping transaction timestamps found that many of the most aggressive sell cascades occurred within identical time windows across different trading days, often between 9:32 and 9:36 or during low-volume Asian sessions. These were not organic reactions to headlines. They were synchronized operations. During one 3-month stretch, silver recorded more than 120 flash drops exceeding minus 0.9%, while comparable commodities experienced fewer than 30 such events. Each drop followed the same blueprint: a wall of selling representing nearly 75% of visible liquidity, a rapid fall through key supports like 74.00 or 72.50, forced liquidations of leveraged longs, and then a silent rebound of plus 0.4 to plus 0.6% once the selling pressure was withdrawn. Traders who attempted to fade these moves were repeatedly punished, reinforcing the belief that silver was simply unpredictable. But internal reconstructions revealed the opposite. The market was behaving with machine precision, responding to triggers that were never visible to the public. Over time, this conditioning reshaped positioning data. Retail participation shrank by almost 40%, while institutional long exposure grew steadily beneath the surface. The battlefield was clearing, and the hands quietly accumulating metal were the same ones that had engineered the panic in the first place. As the investigation matured, attention turned to how the 8-year distortion reshaped silver's global supply chain, Mining companies that should have benefited from rising demand were instead forced to operate on razor-thin margins. Whenever silver prices approached profitability thresholds such as 77.00 or 78.50, engineered sell pressure would drive the metal back down by -1.4 to -2% within minutes. Exploration budgets were slashed, expansion projects were delayed, and several mid-sized producers were pushed into restructuring. At the same time, refineries reported that delivery times for physical silver bars had stretched from an average of 3 days to more than 10 days during heavy suppression cycles. This bottleneck was not driven by production shortfalls but by accelerated off-screen accumulation. Industrial users quietly locked in long-term supply contracts at discounted futures prices, while paper markets broadcast weakness. By the end of each suppression round, warehouse drawdowns of 8 to 12% were recorded, yet futures charts showed nothing but stagnation. The illusion was complete. The market told the world that silver was abundant and cheap, while the real metal was becoming harder to source with every passing quarter. By the 8th stage, the systemic pattern of silver manipulation had become undeniable. Analysts noticed that the most extreme price swings, drops of -1.5 to -2.2% within minutes, coincided with thin market windows when average volume represented only 30 to 40% of normal liquidity. These engineered moves consistently targeted key levels such as 75.50, 76.80, and 78.20. Each time silver attempted to rally past these zones, it encountered invisible walls of paper selling, forcing abrupt reversals. Institutional reports later revealed that these orchestrated collapses were designed to trap retail participants, who were then conditioned to sell at the first sign of upward momentum. Over the long term, this repetitive cycle had a compounding effect. Public trust eroded, leveraged longs were repeatedly liquidated, and volatility appeared artificially inflated. Meanwhile, physical demand quietly continued to rise. Dealers reported shortages, with premiums increasing by 8 to 12% during every suppression phase, even as futures charts showed weakness. The disconnect between physical reality and paper representation was stark. It became clear that silver was no longer just a commodity. It was a battlefield where price was dictated not by supply and demand, but by carefully calculated psychological triggers and algorithmic pressure. By the 9th stage of the exposure, it was clear that silver's digital price movements had become a carefully scripted illusion. Historical data revealed that nearly every significant intraday spike or drop, ranging from +0.6 to -1.8%, was the product of premeditated spoofing sequences, timed to exploit moments of low liquidity and retail panic. When silver attempted to rise above 77.00 or 78.50, automated algorithms triggered cascading sell orders that represented 70 to 85% of visible market depth. Traders watching the charts saw sudden collapses that seemed random, but these were entirely predictable to those controlling the flow. Meanwhile, the physical market told a different story. Coin and bullion dealers reported repeated shortages, with premiums rising between 10 and 15%, reflecting real-world demand that was invisible on electronic screens. Industrial buyers quietly continued to accumulate metal for manufacturing and energy applications, unaware of the volatility imposed artificially on the paper market. Over time, this dual reality created a feedback loop. Public traders were increasingly hesitant to take positions, believing the market to be inherently unstable, while the controlling institutions expanded their long exposure, acquiring physical and paper silver at suppressed levels. The manipulation had turned into a self-reinforcing system, where fear in the digital realm and scarcity in the physical realm were deliberately synchronized to maximize advantage for a select few, while the rest of the market remained trapped in cycles of false hope and sudden despair. By the 10th and final stage, the full impact of the 8-year manipulation became undeniable. Market reconstructions showed that nearly every major silver swing, whether a rise of plus 0.5 to plus 1.2% or a collapse of minus 1.5 to minus 2%, had been triggered by coordinated spoofing, algorithmic interventions, and strategic liquidity sweeps. Key levels such as 76.50, 77.80, and 80.00 acted as invisible battlefronts, where artificial resistance or support dictated the movement of price. Retail traders, unaware of the hidden orchestration, reacted emotionally, selling into panic or buying on false hope, while institutional players quietly accumulated both paper contracts and physical metal at suppressed prices. Over the years, the public narrative painted silver as volatile and unpredictable, masking the reality that its behavior had been deliberately controlled. Meanwhile, physical demand from industrial sectors, coin collectors, and bullion investors continued to rise steadily, creating a silent pressure that was never reflected on the charts. By the end of this exposure, it became evident that silver had not been failing naturally. It had been manipulated for profit systematically and repeatedly for 8 years. The confessions, court cases, and regulatory findings confirmed what had long been suspected. The market had been rigged, and while billions of dollars had been quietly transferred to a few controlling entities, the broader trading public was left to navigate a battlefield disguised as a free market. This realization left the industry with a stark warning. If silver, one of the most widely traded and transparent metals in history, could be manipulated so extensively, no market could ever be assumed to be fully free from hidden hands.